When you're looking to get your feet wet in the world of investing, starting out with a small sum of money can be an intimidating prospect. Most people have the problem of working hard their entire lives but ending up poor in the end because they don't know how to even make even more money. In other words, they have no idea how to invest. Assume you've been making money and have $1,000 in your bank account. So, instead of spending it on other useless gadgets, assume you are going to invest it. But the question is, where do you put your first $1,000? Should you invest in stock or real estate? Is $1,000 enough to begin investing? In this video, we answer all your questions and show you the steps to investing your first $1,000. Whether you want advice on finding good investments or tips for setting yourself up for success once your funds are in motion, watch on. Some short words about what investing is. Before you invest your first $1,000, it's important to understand what investing is, and especially how it works. Investing refers to the act of committing money or capital with the expectation of generating income or profits in return. This can take many different forms, such as buying stocks, bonds, mutual funds, and other investment vehicles. Investing is a way to build wealth over time by taking advantage of the returns on investments. It can also involve taking risks with your money in order to potentially generate higher returns. Investing your money is a smart move for many reasons. Not only does it provide the opportunity for long-term growth, but it also helps protect against inflation and can provide greater returns than leaving it in a savings account. Investing has become increasingly accessible to people from all walks of life, with more options than ever before. With careful research and decision-making, investing can help you reach your financial goals. So with that said, let's have a deeper look at how to invest your first $1,000. The first option with your $1,000 is to leave them on your bank account. The easiest way is to just deposit into a savings account and generate interest. Leaving your money in the bank account might seem like a safe and easy option, but there are drawbacks to it. Over time, inflation will erode the value of your money, meaning that if you leave your $1,000 in the bank account, you'll have less purchasing power in the future. Another problem with leaving your money on the bank account is the bad rates. The highest rate you can probably get is a 0.7%, which means that if you invest that $1,000 into a savings account, 12 months from now you will receive an extra $7. So as you see, you want to invest your first $1,000 in another way, in a more rewarding one. Therefore, the second thing you can do with your $1,000 is to buy government bonds. Investing in government bonds is an excellent way to put your money to work for you. Government bonds are debt securities issued by a national government, and they generally offer a low-risk investment option with the potential for good returns over time. These bonds are backed by the full faith and credit of the issuing country, making them one of the most secure investments available. Investing in government bonds can provide steady income with minimal risk, as well as diversifying your portfolio while still providing liquidity when needed. Additionally, governments typically guarantee that investors will receive their principal back at maturity or earlier if they choose to sell their bonds before it matures. This makes investing in government bonds an attractive option for many investors who want reliable returns without taking on too much risk. This sounds good, doesn't it? When you invest your first $1,000, it is important to understand that high-risk investments can give you a bigger return than low-risk investments. For example, if you put your money in a savings account at the bank, it might only earn a small amount of interest each year, but it is not that risky. But if you buy stocks or bonds, they could go up in value and make more money for you. So if you want to make a higher return on your money but are also aware of the risks, you can also invest in the stock market. Investing in the stock market is a great way to get your money working for you. It can be done with as little as $1,000. Through buying and selling stocks, investors can make money if the stock prices rise or fall over time. Investing in the stock market involves purchasing shares of a company, which then gives you ownership of that company. The price of the stock is determined by supply and demand. When more people are interested in buying a particular stock, its value increases. Conversely, when fewer people are interested in buying a particular stock, its value decreases. For example, if you buy 100 shares of Apple at $170 per share for a total cost of $17,000, which is 100 times $170, and the price rises to $180 per share within 5 months, your investment will be worth $18,000, which is 100 times $180. This means that your initial investment has grown by 6%, making it an attractive way to grow your money over time. In addition to potentially making money on rising share prices, investors can also earn dividends from their investments, which are paid out regularly depending on how much stock they own. Dividends provide another source of income from investing in stocks. Investing in the stock market involves carefully researching companies before investing and understanding longer-term trends to try and maximize returns. There are several different approaches used when choosing which stocks or funds to invest in, such as analyzing financial statements or looking at market sector performances. It is important to do your research so that you can make well-informed decisions about where to put your hard-earned money and look out for any potential risks involved before committing funds. Another bit more risky but a rewarding option can be to invest in cryptos. Again, at this point a reminder, never invest your money if you need it for your daily expenses. Just invest money you could lose in any case. With that in mind, investing in crypto can be an incredibly rewarding and lucrative endeavor. Not only do investors have the potential to make huge profits, but they can also diversify their portfolio to take advantage of the decentralized nature of digital assets. For many, this form of investment has become a gateway to much larger returns than traditional investments, such as stocks or bonds. For those looking to invest their first $1,000 in crypto, there are a few steps you should consider. Firstly, it's important to research and understand the different types of cryptocurrencies available. Different coins have different features and characteristics, so understanding each one is key when deciding which ones to invest in. Once you've chosen the coins you want to invest in, it's time to find an exchange. Exchanges are platforms that allow users to buy and sell cryptocurrencies with ease. Researching reviews and feedback for different platforms is important, as this will give you an idea of the customer service support available if needed. A more secure way to invest your money is by investing in index funds or ETF. Investing your hard-earned money can be a daunting task, especially if you're just starting out. Many people are hesitant to invest because they don't understand the risks and rewards associated with it. Fortunately, there is an easier and less risky way to invest your first $1,000. Investing in index funds or ETFs. Index funds and ETFs are investments that track a particular index, like the S&P 500 or Dow Jones Industrial Average, DJIA. This means that when you buy into these funds, you get exposure to hundreds of different stocks at once without having to choose from them individually. As such, this type of investment carries less risk than individual stock picking, since the performance of any one company won't significantly impact your return on investment, ROI. Additionally, fees tend to be lower than those associated with actively managed mutual funds or any other type of investments. To get started investing in index funds or ETFs, you'll first need to open a brokerage account. You can do this through most major banks as well as many online brokerages. Once your account is opened, you'll need to deposit your initial investment of $1,000 and choose the type of fund you wish to invest in. If you're not sure which fund is right for you, most brokerage accounts offer tools to help you research and choose the best option. Once your funds are invested, it's important to keep an eye on your investments and make adjustments as needed. You can do this by logging into your account periodically to check how the funds are doing, or you can set up automatic notifications to track your investments. This way, if the market changes or one of the stocks in the index does poorly, you'll know right away and can make decisions on how to respond. So there you have it. These are the first steps to invest your first $1,000. Just remember to start small and always do your research before investing in anything. With these tips, you'll be on your way to becoming a savvy investor in no time. Also, it is important to consider the risks before investing. High-risk investments can lead to big losses if you don't know what you're doing. That's why it's essential that you research and understand all the different types of investments before deciding which ones are right for you. Once you have chosen the best investments for your first $1,000, it is time to actually make the purchase. Now we're at the end of this video. If you got value from this video, you'll also like these videos. Thanks for spending time with us.